Oh. Welcome to our fourth Growth Hour webinar from Shed Advisor. My name is Audrey Smith, and I will serve as your moderator for today. If you have any comments or questions throughout this webinar, please feel free to enter them in the Q&A chat box. Or if you're calling in by phone, please feel free to text 540-416-2280. Again, that's 540-416-2280. We will have a Q&A section at the end of the webinar if you'd like to simply unmute and ask us directly. Now, allow me to introduce our host today. Steve Byler has spent the core of his career in the world of sheds, first with the family business and more recently as part of Ulrich Lifestyle. He has worked in all facets of the business, and while still in the shed industry today, his focus is on training, coaching, and equipping leaders in business and nonprofit organizations. He is passionate about seeing leaders grow and lead healthy lives because as go the leaders, so goes the business. He currently serves on the board of the National Shed Rental Association, is a regular columnist in the Shed Business Journal, is a certified speaker and coach with Maxwell Leadership and professional EOS implementer. Welcome, Steve.
Thank you so much, Audrey. Good to be here with all of you today. And I'm especially delighted to have my good friend, Dick Halterman, here with me in the same room. We're not even virtual across two different platforms. We're literally here together in Harrisonburg, Virginia, side by side. I learned to know Dick back in 2009 when my dad and I were in a generational family business transition. We were having conversations, and generational transitions typically are difficult conversations. And we were having conversations around this business transition coming up. And of course, the number one issue is always, what is this business worth? And experience tells us that the owner, founder of a business typically thinks the business is worth far more than the marketplace believes it to be worth. And we're coming up to a time, really a seismic shift that is being undertaken here when the number of baby boomers that are going to transfer literally trillions of dollars of assets to the next generation. And a very high percentage of that value is held in small businesses. And so this is a critical issue. And in the shed industry, we're also coming up into kind of that generational transition. A lot of founders are transitioning either out of the business, need to sell on the open market, or they're doing family transitions. I was in that transitional place in 2009, went to a Chamber of Commerce workshop breakfast one morning, and Dick was doing a presentation on how to understand the value of the business. Chatted to him afterwards. And I used his services then to do a valuation of the business for my personal evaluation as my dad and I negotiated with another third party what that price was going to be that I was going to buy out the majority stake of the family business. Well, we've worked together since then. We spent years together in local business groups, marketing groups. He's a well-known networker here in the area, and literally everybody knows Dick. So just expanding his coverage here a bit today, you need to know Dick as well. Dick is a certified merger and acquisition professional and top producing business broker with Murphy Business Brokers based here in the Shenandoah Valley of Virginia. He has over 3 decades of experience in the business brokerage industry. He's been helping business owners and entrepreneurs achieve their business goals since 1988. He was a practicing CPA for over 44 years, providing him with a deep understanding of financial analysis and accounting principles. And he served clients in a wide range of industries, including manufacturing, retail, healthcare, and professional services. Dick is also a respected leader in the business community, a long history of public service and community involvement. He served on the Economic Development Authority for over 10 years, working to promote economic growth and development in the region. He's held various leadership roles at his church and on various boards for both profit and nonprofit institutions. Throughout his career, he has earned numerous accolades for his exceptional customer service and commitment to ensuring positive outcomes for his clients. He's received multiple awards from Murphy Business Brokers, including the Multi-Million-Dollar Award and the Top Producer Award. As a certified merger and acquisition professional, he's demonstrated expertise in mergers, acquisitions, and business valuations. He's committed to staying up to date with the latest trends, best practices in the industry, and is passionate about helping his clients achieve their business objectives. With his extensive experience in business brokerage and accounting, as well as his commitment to public service and community involvement, he's widely recognized as one of the business brokers in the Shenandoah Valley of Virginia. Dick, absolutely delighted to have you here today.
Wow. That's nice. Thank you.
Well, it's nice.
Yeah, I mean,
Something
you covered it.
you really ought to be proud of it.
I am. I love what I do.
You're not a
I
young
love
guy.
it.
You're not a young
No,
guy
I'm not.
anymore.
You can't tell.
And
It's like,
you know, sometimes it takes us how many years to get to what we really love to do.
yeah, that's a very good point. Following your passion versus following the money. Sometimes people get confused on which they're following. I think if you follow your passion, the money will follow it. So you don't have to,
That's correct.
And
I'm a little behind you. I'm still learning from you, but a little younger than you are. But again, getting to this kind of sweet spot in life, I think both of us are kind of where we love to be.
yeah. I mean,
And
the point,
it's a
honestly,
gift,
Steve,
but-
I'm 72. I can't, people say every day, why aren't you retired? Why would I want to retire?
Yeah,
I'm having the time of my life.
Yes.
It's great. So.
fascinating and fabulous. Really appreciate you joining us here today, Dick.
I'm
So
happy to be.
go ahead and talk to us about business valuations. I also just would note, I used Dick in a little acquisition I went through. I guess this was back in 2015. I bought a business in a nearby city and he did a valuation for that. Again, just trying to get an objective number with a founding owner. It's always a challenging part of the business acquisition process.
It is.
So talk to us about it.
Frequently, as you know, my primary, I guess, revenue stream is selling companies, but you know, as a byproduct of that is certainly valuation. But I often tell sellers, you know, you can't sell a company to the detriment of the buyer and to everybody else that's involved. I mean, you've got employees to consider, you've got customers to consider, and even at some level, you've got vendors to consider.
That's right.
So, you know, but you know, why are valuations important? Because it's kind of an intermediate step before you jump off the end of the either selling or transitioning to family, whatever the next step is for exiting. But you know, why are they important? As you mentioned, I frequently meet with sellers and buyers, and I'm always curious when I meet a seller. I say, you know, don't tell me what you think it's worth. Let me do the homework. Let me do my, you know, crunch the numbers and, you know, come up with my number, and then you tell me. And it's always seems to be one or the other. And like you said early on in your comments, typically the seller thinks it's worth a lot more than what I come up with. On occasion, and in more rare instances, they think otherwise.
Yeah.
So, you know, it's interesting. So having that valuation and learning what people look at to determine value is critically important because, you know, accounting by its very nature is a measurement thing. It's a measurement principle of accounting. And, you know, it's so important in every facet of running a business. Are you at a plateau point? Are you going backwards? Are you going uphill? If you're flat, you're going backwards in my way of looking at it.
Yeah.
So you're either going forwards or you're going backwards. And staying in the middle is not a good place to be either. So the only way you can really know if you're going forward is to have a valuation. And if you're not somebody who frequents the valuation process, in other words, knows what to look for in valuing a company, then how are you going to know unless you get somebody to help you? I think the first time around, it's really important that you get somebody that's done it a few times and knows what they're doing, credentialed in doing it, to kind of give you some guidance. Once you have that, there are benchmarks you can go by, and we're going to talk about that in a second, that kind of, you don't need to do evaluation every single year. I mean, I think you do one, you look at the metrics, you look at the multiples and the things that we're going to talk about here a little bit in a second, and then that helps you propel you, you know, for the next several years. I would say one of the discussion points you and I had before we got together here was, you know, how often do you really need one? And I would say 3 to 5 years. 5's probably plenty, because once you get your metrics down, then you can sort of self-apply. And but all along the way, that requires good financial accounting records.
I'd like to pause there and just settle in on that one a bit. In my prep this morning, I was thinking through what are a couple of the key reasons that business are not saleable. And I was at a seminar recently where a business consultant said that 80% of the businesses that go on the market never actually sell
Yes, it's an
Because they-
astounding percentage.
because they are not saleable.
Well,
And
the records, number one thing, horrible.
records aren't adequate. And accounting, they're not following generally approved accounting principles.
Exactly.
So no gap accounting. And so the numbers are basically meaningless.
Yeah. And you got some people, and I'm sure your audience isn't like this, they play games with their numbers. And, when you start playing games, and the kind of games I'm talking about is taking cash out of it, running all kinds of personal expenses through it. It becomes you can't really get a clear picture of where you're at or what's going on.
Right.
It's okay to get benefits. Don't confuse the two, but to bury the benefits you're getting is not a good thing. Because if you can't show somebody that you're getting this X or Y benefit out of it, then I can't count it, and the buyer shouldn't count it. It just doesn't exist. So, and that's one thing. The other thing that you can run into to answer your question is, and I've got this very situation going on right now with a client I'm selling. They have one client that's 80% of their business customer.
Yeah. So if you lose that client, your revenue could plummet by 80%.
Now, it happens to be a Fortune 500 company they're doing business with. However, the flip side of that is, and most people don't even think about it, they say, well, if you don't hold your mouth right, they're going to get somebody else. That's true. But the other side of that is a Fortune 500 company. What's the aspect of them being sold and having a new owner and then saying, we don't need you anymore?
Yeah.
So oh man, you need to work constantly about not having concentration of clients like that. And my rule of thumb is kind of 10%. You really need to stay below that threshold to have some relevance, because and we can talk about this too. I'm a big believer in culture exchange between buyer and seller. I mean, if you've got the right culture coming in other words, you select your buyer, it's important that you get the right buyer to follow behind you if you're selling. We're talking about selling here now, because if you do, everything else works well. I know we've all heard stories where, they sold the company and never was the same. I can't stand working there. It's horrible.
Hear the story all the time.
It happens all the time. So it's really important when you do have someone that's bringing in behind. We've got to have a situation where everybody wins. I just said that previously, and I'll say it again because it's so important. You can't make a fortune selling your company to the detriment of the buyer. Yeah. It's not fair. You're not being fair to the people that remain behind. You might even make it so impossible for the buyer to get, if he's got leverage in there, to make it work. It could potentially go down the drain.
Right.
So that's a lose-lose. So back to is that kind of what you're looking for there?
Yeah.
Another reason you need to have valuations. I see companies all the time that what I would say are cash poor and profitability rich, or vice versa. Profitability is what you're shooting for, not cash in the bank. Now, ultimately, if you're profitable, there should be cash in the bank. But there's a lot of companies that don't understand. They think they're broke, and it's really a cash management problem. If you're growing correctly, any bank in the world will lend you money because they're looking at your profitability versus your cash flow. So I'm trying to address the question of why valuations are important. If you see that you're in a growth mode and you're properly accounting for your stuff using good accounting principles, you know where you're at, and you can talk to your banker, your accountant, your financial advisor in a very healthy, understanding way.
Yeah, and I just want to follow up on that, Dick. I think many business owners think valuations are for transitions only.
Mm-hmm.
They're actually a bit like creating an objective balance sheet with a true value at a moment in time.
Right.
And to know what my business is worth, and also to know where I can build value, helps inform my strategy.
Absolutely. Here's the thing, a balance sheet by very definition, if anybody that's had accounting or been an accountant or been a CPA, they will tell you it's a cost-based balance sheet. So what that means is you buy an asset in, there's all kinds of assets that come through your balance sheet that aren't as they are reflected at cost. The most obvious sometimes is real estate. Now, a lot of times that'll be in a different entity, And so you kind of have to look at the effects of that. But, you know, so you've got a business you paid $500,000 for, now it's worth $1 million. So you look at that balance sheet, it tells you really nothing. It's unfortunate, but it's very basic in accounting principles that you go on cost basis. Now, another example would be inventory. You may have an inventory in there that you've got valued at cost, and guess what? It's no good. Half of it might be worthless. So you got to really to really understand. I think a balance sheet, you know, to me is a little bit meaningless because you have to kind of go back through and say, well, this is really worth that. You got to recast it. That's what we call it in the trade. Recast it, and that really gives you liquidation value. It doesn't give you the value of the business. And that's confusing for some people. And a lot of people that tend to undervalue the business think in terms of, well, if I sold this, sold that, I can get this for that, it's worth X.
Got almost
They
a fire
forget
sale.
about goodwill.
Fire sale valuation.
Right. It's a liquidation value. That's like if we cash in your chips, this is what you're going to get. And that's the quickest, fastest, lowest value probably you can come up with when
So as a business owner, I always thought it was valuable to know what the fire sale value is.
Oh yeah, that's your baseline.
That's the baseline.
Yeah.
Yeah. What's my absolute baseline? I can get out of this in 30 days if I need to. Auctions and, you know,
there you go.
that's it.
So
you
what
never want to
creates
exit in those moments.
right? So what creates the value in excess of that?
Correct. Now that's what we're going to know how to build.
That's right.
So
that's why you need evaluation, because most people
here?
don't have a clue at how you do that. And that's why you need evaluation. So, and I'm going to get into that a little bit in a little more depth here in a minute. I want to go back to talking about valuation for a second, and we'll come back to methods of valuing. But people say, what drives the value? I can tell you in one word, it's making money, being profitable. That's what pushes the value north of liquidation value, okay? When I get a call from somebody that says, I want to sell my business, you got to come see it. I'm like, no, I don't. I really don't need to see it. And it kind of blows people away. But if that's the first thing out of their mouth, my next question is, are you making money? And guess what the normal answer is? Well, you know, we're doing all right. But they really don't know. I mean, it isn't aesthetics. It really isn't. And I always tell people, and this kind of helps hone in on what I'm talking about here is, you could have one business that's operating out of 300 square feet. They have 2 employees and they're making $500,000 a year. You can have the very same business in 4,000 square feet with 6 people making $250,000. Which one's more valuable? It's a function of profitability. So I really don't care what it looks like. I care if they're making money. You know, only time aesthetics might come into play, and I don't want to say it's not important. It is important when you've got buyers, when you get far down the road and you've got a buyer that's entertaining the potential purchase of the company, putting lipstick on it, in other words, cleaning it up, getting rid of scrap, you know, painting a wall that hadn't been painted for 10 years. That helps, and that makes it quicker and easier to get the deal done. But I'm not saying that it drives value so much.
It's kind of the power of first impression that sets the emotional tone toward a buyer.
Right, exactly.
Yeah, and I've heard various business appraisers make the comment that one of the first places we go, or that buyers like to go, is into the company restroom.
Yeah. Or go through the trash.
How dirty is it? You know, and because it just says something about the culture of the company.
It does.
How attentive are we? But in and of itself, it does not create
value.
If
this guy's making money with a dirty bathroom,
somebody will say we've got opportunity.
Think what he can. Yeah. There's the lipstick you can put on it that makes it more valuable. Yeah, absolutely. And you know, as a process of selling a company, you want to point out to potential buyers, you want to point out to them things they can do. And most people, you all listening to this and following Steve and doing what he tells you, you're going to be doing these things anyway. But, you know, one of the things I want sellers to do is tell me ways that you could have made money and you didn't. Now, don't expect to get paid for it, but this is what's going to help sell it. You know, if I should have had, I have people tell me, if I'd have had a website, I'd have sold, you know, couldn't grief. It would have been crazy valuable. No, I'm sorry. You value it on what you've made. What you've done with it is what it's worth. what you can sell it for, the sizzle that's out there is what you're shooting for as a buyer to make that step and push it to the next level.
Yeah, create additional value.
Exactly.
Yeah.
It might be a good time. I had some notes here I was going by, but it might be a good time to talk about valuation just for a second.
I think I derailed you a bit on your.
That's all right. So, you know, how do you come out of that? How do you figure out the blue sky? That's what we're going to talk about here just a little bit. We use a variety of different, he's going to pull up one of our valuations here. We'll see how good he is at technology here.
So I'm fine in some points, but you know, some days we have a little technical challenge. So you keep bringing some value.
Well,
I'll
all right.
poke around
So
here,
the way you do this, and again, I said everything's tied in and around profitability, right? So when you know, every industry is in a sector, what we call it SIC code or an NAICS code. Excuse me. So you don't, you know, your company is classified in some compartmentalized type of operation that we can, and there are databases out the yin yang. Well, I'd say there's maybe 4 primary ones that we use, but there's these databases where historical sales are very similar. You might be familiar with how a real estate appraisal is done. You know, they'll bring in comps, right? And so what we do when we're valuing a company, what our company does, is we're going out and looking for similar companies to what you have and what they sold for. And then we're benchmarking that back to a number. And typically, this is where it gets a little fuzzy and why you're not going to understand it unless you've been through this once. Once you've been through it, I think it's pretty easy for you to use or compute these numbers going forward. But it's usually anchored off of 2 things, either EBITDA, which is earnings before interest, taxes, and depreciation, or a number we call owner benefit or seller benefit. Now, are we on there now? So you can just kind of thumb through that. Get to page 9, I think is the one I want to get to. This is one of our evaluations, just a sample of some of the stuff we do. That's the one I want to be on, yeah. So there's essentially there's a number of different methods. The primary ones we use there's 6 different ones we go by. Yep, they're right there. The first 3 involve a market approach, which is coming from 3 different databases. Well, I'll back up. The databases we select, and there's, oh my goodness, I'm off the top of my head, I can't remember the names of all of them, but we will select one based on the size of the business. You know, if it's maybe under $5 million in revenue, or maybe 50 million, will have us going in different ways in terms of what we use for market approach, the database we select. But then from that, we look at like the very first one there, Steve, sales multiple. So like, let's say your company's doing $1.5 million a year. And we can relate that sales number to the selling price of the business. Now, I personally am not crazy about that. And the reason, and if you look at the biggest disparity, just that one right there is the first method where they went through. Look at the range. It goes from $1.8 million to $500,000 on that one right there. And, you know, and the reason for that is just because you have a lot of sales doesn't mean you're profitable. So using that as a benchmark to me is one of the worst ones out there. And you can see that it has the widest range of value. So you could have a guy doing $1.8 million and making no profit, or vice versa. But it is a statistic that we gather data on and comps on. The next one is EBITDA, which is the easiest way to think of this is what would the easiest way to compute is take the net income of the business, add back depreciation, amortization, and interest. Now, the reason you take interest out is because there's leverage in some people like no debt, some people like lots of debt. You know, not saying either one of those can run one better than the other, but that's just the way people tend to manage things. So we want that removed from the equation because we don't really care. We just want to look at what you make versus your earnings, what you make versus what the selling price was. So the reason depreciation and amortization are added back because supposedly depreciation is an economic devaluation of the equipment and CapEx you got in the business. So it's not really a cash necessarily, it's something you're spending money on. And depreciation, if you think about it, is skewed very heavily in the early stage of a piece of equipment or whatever you got. And it tends to be lesser in the end. So again, you're trying to get rid of the things that really don't factor in on your multiples. So that's where you start. Earnings before interest, taxes, depreciation, and amortization. Now, in most companies, in smaller companies, you've got more owner participation in the company. Now, what EBITDA does is it factors in a reasonable, we're going to get to sellers, that next SDE in a minute, but the EBITDA is where you've got a company and you have to pay somebody to be you. Think of it that way. You're not in the equation, but maybe it costs somebody, you would have to pay somebody $150,000 a year to run that company. That is what EBITDA is. When we start talking about seller's discretionary earnings, which is the SDE right there, that one right there, that is what the company's making plus any owner benefit, for biggest being compensation.
Yeah.
Others being they're paying my health insurance, they're paying my retirement, they're paying my, I've seen country club dues go through some, any kind of benefit that's going to the owner is what SDE is. So it's EBITDA plus what the owner takes out. Now, again, you've got those first three things. The relationship of what it's sold for to the revenue. The second one is EBITDA, which is if I had to pay somebody to run it, that multiple. And then you have SDE, which is, okay, this is what my takeaway in the business, what I'm getting out of the business, what the business sold for in relation to that. So hopefully that makes sense to you. That's in essence three different columns.
Yeah, and I think in the shed world, where again, majority of these people are from,
right?
The EBITDA and the seller's discretionary earnings, those are the two primary numbers that are often used, which kind of makes sense. The smaller companies use SDE, seller discretionary income, because the owner is so tied up in the process.
Yes, absolutely.
And the larger ones, they extract that value. And I think the critical piece here is, are we talking market value for the roles that are being?
Yeah, that's the hard part.
In other words, is the owner really in EBITDA? Is the owner paying himself market value so that that number doesn't skyrocket or plummet?
And many times he won't, for the main reason being for tax benefits. Like he may underpay himself in a W-2
and take more in distributions.
Yeah, or rent. If he has a facility in a separate entity, he might be taking a big chunk for rent. So, you've got to kind of reclassify and look at all those things and say, to really come. The other thing I want to say about that, your multiples on EBITDA tend to be much higher. And the reason that is because EBITDA is used typically in bigger entities.
Right.
And I'm going to say something north of $3 million in revenue and maybe an EBITDA of $500,000 up. Used to be that was $1 million. Now it's kind of dropped. And there, if you're looking at an EBITDA of $500,000, you're getting into what we would call small, medium-sized companies, but on the small end.
Still small end.
Right. So the multiples on those companies the ranges can be anywhere as high as 10, depending on a lot of things that factor in there. But the typical range is 4 to 6 on EBITDA. And when you're looking at SDE with the owner's benefit plugged in, you're typically looking at a high side of 3.
Right.
So, and again, this particular example, they went through all of those, and you can see the private comps, which was the EBITDA multiple, tend to be higher. It tended to be a higher value, and the one where they're using SDE
this is the EBITDA one,
right? And that's
then
SDE.
here you have SDE,
right? So there's three methods. Okay. Now, what you say? Well, what's the goodwill? What's the blue sky in this company? You have to go back and we won't here, but you have to go back and look at what is the hard asset value. So now we're back to recasting the hard assets. I've got equipment that I paid $500,000 for. Now it's worth $200,000. Subtract that from this valuation number, and the difference is your goodwill. Yeah. So you work at it backwards. To value the company, you look at, okay, what's the max value? What is it worth with goodwill? And then take away the hard assets. What's left is goodwill. So that's how you get that number.
Yeah.
Now, in this particular example, there's three more methods here. Capitalization of cash flow The easiest way to understand that is, you know, if a T-bill is worth, I'm going to use an example. If you had a treasury bill with no risk, you're getting 5% return on it. So it's a 20 times earnings. That's the value of that T-bill. But why is it 20? And these are, we're talking 3 and 6, you know, 3 times SDE, 6 times EBITDA, is because there's no risk. In a small company, you have huge risk. So your multiples, and I get all the time, somebody says, well, if I sell my company, I'm only going to get 3 times what I'm getting now. I should stay in here another 3 years. That's absolutely true.
Yeah.
Stick around. But at some point that, you know, that's going to end. You know, you're not going to, you know, I mean, as long as you're happy making money and continuing to build value, we're going to talk about that concept again, why you want to continue building your profitability. It's a win-win to build profitability no matter what. But, you know, the day of reckoning at some point is going to come. Either you're going to sell it, you're going to pass it on, your employees might buy you out. And we'll talk about that in a second too, about the different methods of exit. But the primary method of exit in my world and most people's worlds is third-party seller, buyer.
Yeah, and in some ways, so in the shed world, a lot of current owners, founders are also looking at exiting to the second generation.
Right.
Which again, in many ways, is again a third-party exit.
It is.
It's just related parties.
Yeah, and you need to know what it's, all right, and I have consulted with a couple Mennonite families in that exact, where you're talking, they're in that exact place. They might have 7 sons and 2 girls, and 2 of the boys work in the business. Now what?
Yeah.
You know, so there's all sorts of ways you can work through that, but to do it fairly, you have to know what that company's worth. And I've seen different configurations, like maybe the kids will own the real estate.
Correct.
You see what I'm saying?
No,
and that's where they get their divvy.
Yeah.
At some
Might
point.
go into a trust or a family.
Exactly.
Family
So
trust of some sort.
there's numerous ways to handle that generational transfer, you know, like that. But it still is important that you know what the company's worth.
The real values.
You have to know.
Real values. So just curious, do you also see some difference? In other words, when you're valuing a company by EBITDA
Mm-hmm.
versus seller's discretionary, is it more common that a company valued with seller's discretionary earnings, the owner is deeply involved and could be potentially less involved
Yes.
in EBITDA?
Absolutely.
So that's one of the reasons the value plummets, is because many of these companies selling on an SDE multiple, the owner still has a lot of the business running inside his own head.
Right.
And there is institutional knowledge that is lost, that's not retained by some long-standing employees or professional leaders, managers inside a company. Whereas EBITDA, again, he could be the CEO.
Right. And an evaluator, this is the hard part. It is math. It's probably 70% math, but 30% of this evaluator's head is looking at the dynamics you're talking about.
Correct.
And how much he's going to put weight on one versus the other, and the determination of the value.
Yeah, and that's often the buyer has to make those discernments.
Right.
What am I losing when that person leaves? Who stays in the business? Who leaves? How much industry knowledge do I have versus how much do I have to depend on internal people
Right.
for industry knowledge?
I'm not going to spend a lot of time on multi-stage growth, but what that's looking at is it's over time, what's the growth potential of that company? And there's a number of economic calculations, but that's yet another method of coming up with the overall value. And the one that's the last one there, the 10% down, 1 point debt service coverage, that's what we call in our world the acid test. There's a lot of names for it. The acid test, that's the one I like, because it's like, okay, have we overvalued this thing? And what that does, it's a function of, is this thing bankable? You know, you can think it's worth a lot of money, but if the bank, you know, in my 9 cases out of 10 of the people I deal with, SBA's involved somewhere or some lender, and that's where the bank goes through and they say, oh, if he puts X amount down and we get this much in debt at a certain coverage ratio, will it pay itself out? Now, in this example right here, that is very, you see, if it can sustain the value that the loan affordability thing does, which it does, because his final value on this thing is 1.095 thousand, which is the median of all these. The median is not the average. Let me make that clear. Why do you do median? Because you want to get rid of the the outliers,
Okay.
both high and low. So the reason he's looking at the median scores on all of those, and he's coming up with a number of 1.095 million. He's also million, but he's also coming up with an equity value. So what is that? That's kind of the typical. That includes all the assets on the balance sheet. So value of stock is the way most people like to think of it. What's the equity value of the company versus when they say MVIC, market value of invested capital, they're only talking about a couple things: no cash, no debt. So what is the equipment, the inventory, and the goodwill? That's really what MVIC is. Market value of invested capital.
And that's this number right here.
Well, that's equity value.
Oh, that's equity value.
That's
right,
equity.
Right.
So that's the value of the stock. This is the value of the hard assets. Not the hard assets, the hard assets plus goodwill.
Plus good.
So what if you look at that example, he came out with a value of 1.095 million and as the median score. And if you look at the median score on the debt service, that should easily bank. That should be no problem when a bank goes to look at it.
Right.
And if that number had been, let's say that number had been 800,000, you got a problem because what it's telling you is your comps and your cash flow exceed what the bank would be willing to loan on it. So what would be an example of that? Potentially a strategic buyer who's somebody already in the trader business who would be willing to take on their economies are different. The overhead that they would have to, they bring another company in that does what they do. Payroll expense, it ain't going to change.
Yeah.
Insurance, it's going to go up some. There's some incremental costs, but there's not enough. You're creating cash flow that supports a strategic buyer, if that makes sense.
Yeah.
So that's the kind of example you'd have where the bank may not do the deal, but a strategic may step in and buy it.
Right. Makes a lot of sense. And strategic buyer can often eliminate some of the overhead costs in the existing business they're buying. They see immediate value, which makes those adjustments work.
Precisely. So a strategic buyer, if he's getting into the same line of business, that's easy to see. But let's say he's a vertical, like it's a related business to what he does. Now there's other things that come into play. You've got a cross-pollination of customer base.
Right.
So now maybe I'm trying to think of how that would be in the shed business, like the rental business. I guess the shed and the rental business.
So we have a lot of different models in the shed world. Some are just manufacturers.
Right.
Okay. And wholesale.
Sure.
Others are manufacturers and then they use dealer models to sell.
Right.
Some are vertically integrated. They're a manufacturer who drives all their own sales, leads, marketing efforts, sells all their own products, installs their own products, and has both rent to own and financing options, all in a long vertical with customer service.
Right. That's a vertical market. That's a vertical strategic
model.
Yeah.
And you can plug, so a vertical, somebody in the shed world might do acquisitions in various places there.
Yep.
And still get integrated.
Build it up instead of out.
Yeah, exactly.
Yeah. So that pretty much, I mean, that's enough time. We could spend days on this. I mean, it's a whole site. You got to be the people that do it with our firm. We have a division of our firm. They're CVA, Certified Valuation Analysts, and it takes a lot of schooling to get to doing one of these, and trying to cover it in a New York minute is hard. But what's important to take, the important takeaway from this is you're going to get a value versus your revenue. Okay, that value of $1,095,000, you apply that. Let's say your business revenue is $3 million. Now you know that about 3 times my, or a third of my revenue is going to be the value of the company, based on how I run it. Now, if I improve efficiencies, there's the problem with using revenue again. We go back to, like, you need to understand what SDE is and the EBITDA, because then you can look at the multiple on EBITDA. And let's say your profit, let's use the EBITDA example, and a median value and a value of $1 million. Let's say your EBITDA is $500,000. Now you take that EBITDA to $1 million. What's your value? It's $2 million, $2 million plus.
Yeah.
It's 2 times that.
And again, just in the shed world, smaller companies tend to bring lower multiples,
Right.
because they have complexity with a lower level, typically of leadership, that drives value. Then your little larger companies, multiple tends to go up a little bit. And if you get into the really large companies, they often have much higher multiples, but they will also have professional leadership, good, solid professional management teams, rather than kind of these guys who are managing, but are still primarily in the task space.
You're exactly right. And
And
wait,
so the values, so a couple of companies can get together and grow their value
mhm,
by really becoming professional in the industry.
exactly, getting better at what you do, and then a typical growth strategy. I deal with people do this all the time. Or you can grow your business by buying other businesses. I mean, we're talking about potentially here. We're talking about what if I sell my business, but one way to grow your business is to go out and acquire one. But
Yeah.
you need to have your act together.
Correct.
Before you start thinking about something like that, which addresses the kind of things you're pointing to out here right here is good leadership, good people in good positions. The culture's good, strong, people want to be there and work there.
And I also see these companies have proven processes. They've systemized what they do, they're documented, and a turn of people is less critical,
Right.
because they can be onboarded into a good, healthy operating system. Okay,
Yeah, so
now, at the risk of self-promoting here, right? When a company moves from kind of an operating system that runs inside the head of the entrepreneur goes away, you typically have chaos.
Right.
And so a new buyer is buying chaos.
Right.
The owner's gone.
Right.
You get a good operating system, systematic strategic planning and execution. Everybody knows how the business runs. Typically that multiple goes up by 1 or 2 points.
Yes, it does.
Right out of the gate. And so when I'm working with companies to bring EOS, for example, to the company, that's a proven operating system that in multiple industries, there are examples. Company switches from this random operation to a proven operating system. They automatically add 1 or 2 points to their EBITDA.
Yeah, and here's the thing, Steve, and we slightly addressed that a minute ago is, why would you want to be more efficient? Well, the goal of being more efficient and more systematized and all these things that we're talking about is to make more money or to be more profitable. Okay. So, I'm telling you how to drive value to get at the day of sale, but what happens in between? If you're pushing those numbers north, you're working less and doing more with the resources you have.
Correct.
Which is a good thing. So I always tell people, they ask me, what's the most valuable business out there? I say, it's the one where you don't have to be there for 2 months and the thing works like clockwork. And how do you achieve that is exactly what you're talking about.
That's right.
So it seems it seems like a oxymoron that the more you're not there, the better, the more it's worth. But it's the absolute.
That's true. It's exactly true. And so again, I've seen 3 things I jotted down. I'm just give me feedback here at the end.
Okay.
3 things that I've seen destroy value in businesses, making it difficult for the owner to exit. One of them is owner dependency.
Mm-hmm.
Okay, the process, the industry knowledge, everything lives in the owner's head. And if he leaves through a sale, unless the buyer is just clueless, that business is not a saleable asset.
Nope, you're absolutely right.
Okay, and the second one is that they're not following GAAP accounting, generally approved accounting principles.
Sloppy bookkeeping.
It's sloppy bookkeeping, and you have to do all this work to try to get something that can be understood. And then it's a bit of a guess. Did we do all the add backs? Did we take all the stuff out?
It drives me crazy when people try to save money by not keeping it drives me crazy. How do you know where you're at?
Well, you can't.
You can't.
And then you can't manage. So
Right.
only what you measure can you manage.
Right.
So that messy accounting is just really, it's a failure to invest in something that drives true value in a business if you don't pay attention to your books.
Right.
Okay, and then the third one is simply the absence of documented, clearly understood way of operating.
Yep. It needs to be in writing.
Those 3 things, especially in this small,
what if you come to say
$1 to $5 million?
I mean, there's all sorts of things that life happens,
That's right.
and you don't want to prepare for that. You don't want to think about those things, but you need to prepare for them. And if you prepare for them, it's beyond just helping you in a disability situation.
Correct.
It's good for the entire operation.
And really, the owners get a life.
Right.
They have a life, not just a
Yeah.
business.
Do you want to go on vacation and get 6 phone calls a day come on.
I've done it. Don't recommend it. Okay, but really the business has you by the tail at that point.
Right.
Yeah, and so valuation is one of the powerful tools to get crystal clear on the valuation. And often with a good valuation comes some clarity as to how I can actually build value going forward.
Exactly. And so, you know, you talk about this measurement principles, which what you're talking about with accounting measurement. So the first level of measurement is good books, so that year over year over year, you can say, am I going forward? Am I going backward? Now, valuation is the extension of that, because your balance sheet is not going to tell you if you're improving. It's not. The only thing it's going to tell you is understanding valuation. Like, what are the multiples that I need to be looking for to see what the end value is?
That's right.
What else we need to talk about? Got some notes here. Oh, let's talk about one just really quick. I know, what are we about ready?
We're gonna wrap up here in just.
Let me say one more thing. You know, talk about exit strategies. What are some of them? You know, obviously the big one is why I've got a job, basically, is selling to third parties. So independent third parties. Again, we talk culture, why it's important. Good culture transfer, make sure everybody's a winner, not to the exclusion of the seller. You want to make as much as you can fairly and treat the rest of the people fairly. Succession planning within a family. You've got kids that have worked in the business, or
really
maybe
critical.
Yeah. So you can also sell to management. You've got a good manager behind you. He's 20 years younger. He wants the company. And I will tell you, there's preferential lending treatment for people like those two categories, because they know the business.
Yeah.
That's the big thing. You know, I can tell you on an SBA deal, there's two things that make all the difference. The resume, like, can this guy run this business, and is there cash flow in the business? Now, most banks traditionally you know, I would say conventional banks, not that they're not saying anything bad about them, but they loan based on collateral. They want this. So you can literally buy a business as a person with almost no net worth, as long as you got the resume to back it up, the down payment that you can make, and so you understand the business, and the business has cash flow. The other, and ESOP is another way to go. It's a more formal process. It's very expensive to administer. It is a very good way to exit a business, but you got to have, every employee has to be focused in on, they got to be concerned if they pick up that nail they drop, that it's going to save the company money. You got to have everybody thinking in that way.
They either work really well or they're terrible.
Yeah, that's exactly right.
There's
some good ones. Com Signings locally is one of them. There's
some great ESOPs.
Yeah. So and then an IPO, we're not really in that league. That's one way out. Public sale of securities, liquidating. That's like you said, if you're in a hurry, that's one way to get money.
Call the auctioneer.
Yeah, call the boys here in town. And then the reason that it might be a liquidating value is you don't have enough profit. You're not making any money. That's one way to go. And then, so gradual withdrawal. Let me say that one thing about that, and I'll stop.
Yeah.
A business is always worth more if the owner is willing to stick around for a bit and make it kind of transparent that the change has occurred. You got similar cultures coming in. The owner still shows up, he waves at people, and he walks out the back door when he leaves in the evening. If he's willing to do that, he's probably going to command a little better price on the sale of his business. So enough said on that. That's gradual withdrawal.
Yeah. Excellent. I'm glad you brought those in. Forgot about that, honestly.
Yeah.
But these are all excellent ways of exiting and planning to exit your business. And again, valuation is important. And that if you're an owner and you see you're the need to exit within the next 10 years, that's about what it takes to build a really, truly excellent exit from a company. And
if you're wanting out, don't wait till I gotta sell it today. No, that needs to be to be. It can take. I can tell you horror stories. I had one that was a company in Smith Mountain Lake. Took 5 years to sell that thing.
Yeah,
and a lot of it was positioning. He didn't have it ready. You know, I had another one. I just closed on one last year. Same thing. Just wanting to do it on the fly, and you're not going to do as well. The planning. You know, we talked about plan. You talk about it all the time, and what you're doing here. Don't try to do it in a hurry.
Yeah, and even for family transitions. Again, I have friends who talk about their family business transition was the cold, clammy handshake.
Mm-hmm.
Their dad was on a ventilator in ICU. The son, there's no plan in place.
Talk about those things.
And the dad just basically squeezes his hand, and now he's going to be the next owner, and dad's gone.
Yeah.
Okay, that's a terrible setup for the next generation.
It really is.
It takes planning. It takes careful planning. It takes extended planning for good, healthy transitions. And again, knowing the value,
You
It's
know,
just such a critical
it
foundation.
all
piece of
comes
this.
back to the whole E-Myth thing, and that is, don't work in it, work on it.
Yeah,
And if
okay,
you're not,
and that's the book you recommended to me in the Chamber of Commerce when we
yes, it
first
was,
met.
that was,
And I bought the
that's
book and
one of
read
my
it,
favorites.
and then we went to work on it.
Yeah, yeah, you've got to be, if you're doing your job as an owner, you're looking at how you can improve and tweak. You're not out there selling widgets all day long, and that's a bad example, but you get my point.
Yeah, that's exactly right. Okay, well, we could talk a long time,
Yes, we could.
but any questions? Again, opportunity, submit questions in chat,
Do we put you to sleep?
or maybe that's why they stayed, because they all went to sleep. You know, no videos, 1 or 2 videos turned on, that's about it. But any questions that you have for Dick here while we've got him on the phone here for the last few minutes? Audrey, have you seen anything come in?
Well, I have 2, unless anyone else wants to jump on in, feel free to unmute.
Okay, so somebody just showed up on video. Raise your hand on video if you're interested. If that's helpful, we'll take your call we'll take your questions live. Or let's go ahead and take one.
We'll take one.
Take one that we have submitted earlier.
So I think you touched a little bit on this right here at the end, but what are a few ways to determine if selling a business is the right choice?
Okay, so if it's as opposed to what, retaining it? I'm not sure I understand exactly what you're saying there.
So people do come up to a decision, do I stay or do I try to sell? And so I'm 65 years old. I'm not. But I'm gonna be. Okay, I'm running the business. How much longer should I run the business?
I'll say
How do I
this.
decide, do I
Let
start
me
the
say
exit?
this. A lot of the deals I do, a lot of them, the business went like this, and then the owner gets comfortable. He's making more money than he ever made in his life doing nothing.
Yeah.
And so what happens? It plateaus.
Starts, yeah.
Right. And when you get to that, a couple things can happen. You can lose people that help you sustain that.
Right.
Because that people want to work for somebody they feel they feel good being there. It's not just a paycheck.
Well,
They like the culture of the company
Yeah.
and they want to be there.
and you lose, so a company that plateaus,
Yeah.
your high performers are the first to leave
Yep.
because they don't see increased opportunity inside the company.
Then what do you got?
And then you're left with a company that can scarcely maintain. And usually you get a few high performers out of the company, it actually begins a rapid decline.
Right. So the answer to the question is, you're still enjoying it and you're still growing it. I'm 72. I'm doing this. I mean, it's growing for people like you.
But you're not running a company that's got you locked in day in and day out.
No,
60 hours.
Absolutely.
Okay, and that's
I
one
pick and
of the
choose.
keys.
Yeah.
And often this decision to sell becomes actually a lifestyle question.
Right. Exactly. What do you want to do?
And how much freedom do I have? How much is the business demanding of me? And when do I need a shift in demand?
That's exactly right.
Yeah.
Is that good for you, Audrey?
Yeah, I think that answered the question, absolutely. If anyone wants to jump in here for the second one.
Anybody raise your hand, have something you'd like to ask?
Feel free to unmute. Okay, here's the second one. Does the business entity determine which valuation method is used?
Not really.
Okay.
Business entity is important from the tax side of things in terms of how much you get left with. Now, I will say, when you sell stock, it's a straight out capital gain. The equity we talked about there earlier, when it's an equity transaction. In my 28 years or so of doing this, I maybe had 2 stock deals the entire time out of probably 45 deals I've done.
Really?
Yeah.
So
Mostly it's an
asset
asset. So
sales.
why is that
Asset
true?
sales.
Why is that? Because a buyer, if he comes in and buys assets, he's got depreciable assets to write off. Goodwill even is write off.
Right.
15 years versus whatever the equipment is. But you got an asset to write off. When you buy stock, that's your basis in the stock. You have no write-off. You're starting with exactly like one day it's this guy, next day it's this guy.
Yeah.
Nothing changes. Same
You're left
depreciation
with
schedule.
depreciation tables and everything.
That's why most people buy assets.
So you can restart the.
So that's a battle. That's why people like us exist, because It's about setting expectations. Like, okay, here's what's gonna happen. You're gonna have a 20-30% tax bite when you go this route. Now, I will say sub S corporations over C corps. C corps, if you're in a C corp, you need to start talking to your accountant, because you can end up in a 50+% tax bracket. Yeah, it's ridiculous. But if you're in an S corp or a partnership, or even a single member LLC, you're probably fine. And
there's another reason to do a valuation.
Yeah,
Because
those
you get an assessment of what the exit potentials are. Somebody's
Exactly.
gonna look at it.
Exactly.
Yeah.
So yeah,
Excellent.
hope that helps. What are
Excellent.
we at? 12:57.
Okay, yeah, we're about ready to wrap it up here. Just a couple things in conclusion. Thanks so much for joining us
Oh
today.
man,
Just fantastic to be
we're
with
buddies.
you.
Yeah.
Good to be with you in the room, have you in the room. Our next webinar is on Valentine's Day, February the 14th at 12 noon. And I'll be honest with you, I forgot to check who our guest is, but there will be some great content there again. And the next one then, the very end of March, I've got some vacation time there that kicks it off a bit. So Friday, February the 28th. And if you're in the shed industry, particularly, I'm not here trying to buy businesses or help sell businesses, but I do know buyers who are currently buying shed companies. And if that's you and you're looking to make a connection, drop me an email, give me a call. I might be able to put somebody who can help you get there. But meanwhile,
Hey,
Dick,
let me add a
like
comment
that.
to that. I mean, yeah, because what he's talking about is strategic buyers. And what did we say about strategic buyers? If you paid attention,
Yeah.
you should get better numbers.
Strategic buyers will give you better numbers because they have an existing industry business to plug it into, and often can add technology, can increase, and maybe even be a partial exit and allow you a second exit at some point in the future. So there's just lots of interesting things happening. Shed industries, again, pretty new, but we're going through the large generational transition. So there are strategic buyers showing up in the industry, and be happy to make any connections with you there. Feel free to reach out with any questions. And you'll see information here for Dick as well. His website was earlier, and it reminded again, it's
Halterman-Murphy.com.
Halterman-Murphy.com. And if you just Google as well, Richard Halterman Murphy Business,
I'll show up.
He'll show up. And always get stuck, you can always reach out to us by email and we'll send you contact information. And he can certainly help you with valuations if you're at that place as well. So thanks so much for joining us here today. Always great to be with you. We invite and welcome your feedback as well. After the last webinar, I had a couple folks text and tell me what they found valuable, gave me some tips for improving. So thanks again for joining us. And I do wish you a very successful year in 2025.